Chevalier from Paris. We start now session 3 of this company evaluation course. It means it will be a bit more complex in terms of calculations and concepts than the two preceding session. We agreed this morning to postpone the tomorrow session, and because you have to prepare very carefully the financial structure exam, course taught by Professor Pramwan, and we can have our course a bit later. It means next week, and it is 3 Remember, we have this course on the 27th, and the last course where you will go through your presentations will be on 17th and 18th. What you will be split into subgroups. In fact, for this last course, and your exam will be on the 21st of November. Okay, so I think that's clear, and that's allow you to work more, to prepare more carefully the exam of the financial structure course. And for today, we have a session which is based on the slides you received. We have a large number of slides here, 26 slides, and it will be organized mainly on an exercise, a case, and then we go back again on biotechnology. If I want to summarize the topic, the first one is from investment analysis to financial plan and valuation, okay, which is really the case of the first exercise on lean and of biotechnology. We will have a question of book value and market value again, which is very central. In fact, if we use multiples and find this analysis or this presentation discussion in all the 3 exercises and cases, we will make calculations using models, mainly in the signal case, with capital asset pricing model, for example, which is very central here, leverage approach, and so on. I postponed, as you know, the last 3 of the slides of the last presentation for session 2 on leverage. So I will use these slides in the next session, in session 4, after completing the presentation and discussion on the signal case. And of course, I will introduce scenarios, mainly with elements of questions, more questions I raise on both cases, and you have to take into account for your presentation scheduled on November the 17th and November the 18th. So this is what we want to do today. If we come back in more details to the presentation and what we did last time, for today we'll say a few words on session 2. That's what I do always, to summarize what we did and where we are. We'll come back on investments. We have a few more questions coming from past exam. We will go through debt capacities, multiples and values, and multiples raise many questions because that's most simple approach. But anyway, we have bias in this kind of approach. I will give you a few more data and explain what I want in biotechnology, perhaps more clearly in more details than what I did in the 2 first sessions. And we will spend most of the time on the electrical signal, which is another case. I will introduce a case, go with you into calculation, and also present you and what I'm waiting for you for the presentation for that case. And if we have some time left, I will go through a few more questions coming from past exam. That's what we will do. And you received also progressively 3 different past exams. The first one I distributed, was the last final exam I gave to your colleagues, which is exam from November 2021. I sent you also yesterday the September 2018 receipt exam, and we use the Charles Company exercise and some of the questions which were raised in this exam. And this morning I sent you another one, which is the final exam. It is the final January 2019 exam. And good questions. I have a question again. We will use, and we start with this exercise which is called part 5, that capacities, multiples, and values. The name of the company then is Aline. And we have a few questions in this exercise which allow us to go through other kind of calculation in concepts compared to what we did in the preceding sessions. So this is what we plan to do. Remember that in session 2, last time, it means yesterday after evening, we went back on session 1. Had a discussion, presentation, discussion on leasing and consequences of leasing on the WACC, but also on debt capacity, financial structure. Presentation on preferred shares, which will be very useful for the case on the case I call Signal today, because they have preferred shares in that case. We went through a summary of different models, discussed about the market to book value impact, and brought more on Gordon Shapiro with some calculation, and skipped point 7 and point 8, but went into detail in a large amount of the question, which are in point 9. We have 2 slides there, and we studied the majority of these questions. But what we did up to now. Okay, so this is for, this was for yesterday, this is for today, and we will start now with the first case, and first case is the Aline company case. I will present the elements of the case and the elements of the calculation and discussion. But anyway, if you prefer to read it on the case itself, it is January 2019 final exam, part 5, and you received this exam this morning. January 2019 final exam, part 5. So we have here, and if you have a look to the case, you see, you understand that we have 7 different questions, and we cover a large part of what we have done in the past, which is related to valuation. The first one is a simple and classical question. It goes back to one of the preceding courses we spent together. It is on the free cash flow and the debt capacity. That's just kind of, I would say, short reminder of what we did and what is also necessary when we go through valuation. And later on investment capacity, debt capacity, opportunities to be sized in terms of acquisition. It's also an application of what we did in the past, but also a good introduction to what we will go through into the M&A course. So read that side together. The equity and liability side of the balance sheet of Aline Company is the following one. Total equity 12,000 euros, long-term debt 6,000, medium-term debt 3,000, short-term financial debt. I don't know why I did it here. Short-term financial debt 1,000 euros. The free cash flow of the company is supposed to be 4,000 euros, and the question is a classical one. You should be able to answer to and get 0.5 points if you have a kind of question in the final exam. What is the debt capacity of Aline Company? So let's have a look immediately to slide 7. And on slide 7, you have the usual calculation with the first ratio, long and medium-term debt divided by total equity, which is 6,000 for the long-term debt and 3,000 for the short-term debt divided by 12,000, which is the total equity level. The result is 0.75 or 75%, as you prefer. Okay. According to the financial structure that to this calculation, the financial structure of debt capacity is about 3,000, which is in fact the difference between 12,000 and 9,000. With 3,000 more debt, the ratio will be 1, which is supposed to be the maximum debt equity level accepted. Now, if you compare the second basic question, you leave a structure, a financial structure, and you compare the level of debt and the cash flow. It means you calculate what we can call the capacity to pay back or to repay the accumulated long and medium-term debt. Make this calculation, long medium-term debt divided by cash flows, and you get 9,000, still the same number, 6 plus 3, divided by 4,000. And now if you have a look to that, you know that the maximum capacity, debt capacity is 4 times 4 years of cash flows, and 4 years of cash flow is 16,000, which means that according to this approach, the debt capacity, which is still available, not used in time, is 16,000 minus the 9 existing thousand, which is equal to 7,000 euro. If you have a look again to the 9,000 divided by 4,000 ratio, you understand that it represents about 2 years and one term and 3 months of cash flows. That means it's quite far from the 4 years of cash flows which is generally accepted, and means the company is not has not a very high level of debt. So now you get 2 different data, 2 different results coming from the calculation. From the financial structure on the right side of the balance sheet, you get 3,000. And from the calculations in terms of repayment, of returns compared to the level of debts, you get 7,000. And we know that 2 constraints have to be met, have to be satisfied, which means that the lowest one is, of course, the right answer. The debt capacity should be equal to 3,000 euros. In that case, we went through exercises, and that we know that if we want to increase the debt capacity, we need to modify, to improve the first ratio, the financial structure ratio, long and medium-term debt divided by total equity. And the only way to do that, is to increase the level of equity. And the only way, in the short term at least, to increase the level of total equity, is to bring more cash in an equity issue. It means if you have a CFO, you should ask the shareholders, to buy new shares, bring cash, and increase the level of total equity. That's where we are. Now, after question 1, we can move back to, what is it, question 2. And question 2 should be here. And question 2 is a bit different, it is said that the book value of a share is 100 euros. So you should always remember that, of course, book value is useful in the accounting system. It's not so important in finance. We are much more interested by the market value, of course. We know today, at the time of the analysis at least, that total equity level is equal to 7,000 euros of retained earnings and 5,000 euros of equity. We knew in question 1 that the total value of equity, book value, is 12,000. Now we know that among these 12,000, the shareholders brought part of it, and it is equal to 5,000, in cash, and on the other hand, we have 7,000 euros of retained earnings coming from, the net earnings of the year before the analysis. Means it's part of the total net earnings or net income, as you say, of the preceding years. And we see what's really happened in many cases. It is that progressively, the total equity level is made mainly of retained earnings. When firms are profitable and accumulate retained earnings year after year, in a few years, you see that retained earning level is higher and sometimes much higher than the level of equity. And that total equity is mainly done by retained earnings. And this is well on the way here. And the question here is, what is the number of shares of a company if book value is 100 euros and we have equity, we have equity for 5,000 euros and 7,000 for the retained earning. Okay. So what we know is that the total value of equity is 5,000 euros and the book value of a share is 100 euros. And remember that when we create more shares, they are registered first for their book value, which is also 100 euros. And if the price which is used is higher than the book value, it means the difference between the price which is paid, cash which is brought by the shareholder, and the book value is incorporated, registered into the other element. It means incorporated into the retained earnings. So it is clear that the number of shares here is equal to 5,000 euro level of equity divided by the book value of share. It is 50,000. Okay. So this is what we find. Next, we know that the market to book value of a lean company is 2.5. Okay, market to book value of company is 2.5, which means that as we have a book value which is equal to 100, if you put the question at the level of the share, we have 100 multiplied by 2.5, which is equal to 2,050 euros. This means we are also able to calculate, if we need it, which is not the case here, the total value of the company, because the market value of the share is 250 euros, and we know we have 50,000 shares. So if you multiply 2,050 euros by 50,000 shares, you get the market value of the company. That's what you have. So this is for question 3. Question 2 and question 3, and go back to question 4. Question 4 is a bit different from the preceding one. The CFO wants new investment projects financed 100% by debt. And this project is a 4,000 euros project. So the question is very simple here. It is, what is the financial decision to be made before going into this project? And of course, question, which is the second question here, is do we use book values or market values in the calculations and Brendan discussed? And you will see that this question of market value and book value to be used will be raised also again in the signal case we'll go through later today. So this is a new project, 4,000 euros, and for reasons which are not explained here, he wants to finance the project through debt. So the question is very simple. You know, we know that the debt equity ratio is 75%, question 1. We know that the debt capacity is 3,000 euros, and that means that we cannot finance 4,000 euros by debt. We have to do something before. Okay. So what should be done? It is to increase the level of total equity. And for example, if you increase the level of equity by 1,000, you will add 1,000 debt capacity to the financial structure, which means that the project could be financed 100% by debt. So, simple answer. We recommend an equity issues for cash for 1,000. If you increase by 1,000 the total equity level, you increase also, we improve the debt equity ratio, you get 1,000 more debt capacity, and if you add the 3,000 you already got and the 1,000 obtained through the equity issues, you get 4,000 debt capacity, and you can finance this project 100% by debt. But what will happen at that point is that there is no more, if you do that, after making this investment and financing this investment by debt using the 4,000 debt capacity, you will not have any more debt capacity, which means it will be difficult to finance any other kind of project, or you will have to finance it using only only equity, which is quite limited. So perhaps you can have a second recommendation. The second recommendation could be to make an equity issue not of 1,000 for 1,000 a month, but a larger, for a larger amount, for higher amount, something perhaps like 3,000, 4,000, and in that case, you will increase the debt capacity, since you will be able to finance by debt the 4,000 investment project, but to keep some debt capacity available for to size any other kind of project which could be available in the month to come. So this is question 4. Now you have a question 5 somewhere. It is on slide number 6. And on this question, the CFO wants to finance, the CFO signs a new leasing contract, 3,000 euros, to finance a second investment. What are the consequences of the above calculations? Are they different for financial and operational lease contracts? So you have mainly 2 questions. He signs a leasing contract, 3,000 euros. He wants to finance a second investment, right? What are the consequences on the above calculation? This is the first part. And are these consequences different or similar or identical for a financial and operational lease contract? The answer, of the second part of the question is quite simple. That's what we studied yesterday. Again, we know that operational lease and financial lease are not registered, taken into account the same way, at the same time, in the accounting system and in financial analysis or financial policy. One of them, the operational lease is considered as a cost and is year after year integrated into the income statement only. The other one, the financial lease, is supposed to be some kind of debt. That's what I was trying to explain yesterday when I presented, the different categories of long-term financial resources from ordinary shares to straight bonds. It is one of them. It is closer to a debt than to equity, and it is considered in the I would say economic analysis we can make starting from the accounting system as a debt, and we incorporate the equivalent debt level at the beginning, which is in fact the value of your asset, which is financed, because with a leasing contract we finance 100% of your asset into the right side of the balance sheet, as we do with a debt contract. Of course, the equilibrium is made with an asset value, which is supposed also to be for the same amount on the left side. Okay, so we have clearly 2 different cases. Cases of the operational lease and the financial lease are completely different, and the financial lease is considered as a debt, for the total value of the asset which is financed. The only main differences are the options, and you remember that kind of contract, you have at least 2 options. The first one is a call in the hands of the user of the asset. It's part of the definition of a leasing contract, and this call can be used only when all the yearly rents are paid for a residual value. Best residual value is calculated in a different way in the common law countries and in the code countries. Okay. Second one is an option which is in the hands of the lender, means of the leasing company, banking group, in fact, in many cases, and it is a protection, it's kind of insurance in the hands of the lender, which allow him to bring back home the asset if the rents are not paid in due time. Okay, so we have also to take into account these elements. Okay, so what does it mean? It means, of course, you have an increase into the debt level, and if you recalculate the debt equity ratio, now you have 3,000 more debt in the total debt level. But the question is, what about the 100% rule? The 100% rule, of course, move because the risk is not the same in that kind of situation and financial resources used, leasing, if you compare to a case with classical straight debt, because of the second option in the hands of the lender. This is, in fact, an insurance or hedging policy which is incorporated into the contract. That means that the equity ratio will increase by 3,000, okay, but also you will move the limit which is acceptable because you had less risk as a lender if you compare to the same investment financed by classical straight debt. This is what we find. So you can make, of course, a short calculation and increase the debt equity ratio. It means if you take into account the first data, and you had 9,000 of debt at the beginning for 12,000 of equity, you had the first investment, which is a 4,000 euros investment financed by debt, but you decide, for example, to increase your equity level by 1,000, and you get, of course, 13,000 both sides, which is a ratio equal to 100%. Okay, so the case we have here is the possibility to increase above the 100% of the debt equity level because the leasing contract contains in itself, a protection against problems of liquidity and solvency of a borrower. It's a hedging policy which is incorporated through the option into the contract and into the balance sheet structure and the debt equity ratio. This is what you have to expect. So number 6 is more, I would say, classical. It's really an application. Generally, you like that kind of question. Let's read the question together before moving again to the answer here. Perhaps I should add something more here. If you see that slide in point 5, and what I wrote here among the elements of ANXA, we increase the debt capacity. That's what we said. It means we increase also the total cost of debts, because leasing contracts are more costly than classical straight debt. But in fact, if we compare to a solution which incorporates for the second investment debt, straight debt, and equity, we will have a decrease in the cost of resource, which means also that we'll have a decrease in the WACC level after financing by leasing, if you compare to something like, let's say, 50% debt and 50% equity, because the cost of equity is much higher than the cost of leasing contract and the cost of this other straight debt. This was another point here. So let's move back to a question, which is on slide number 6 here. And slide number 6 is with question 6, because we have been through 1, 2, 3, 4, 5. A risk-free interest rate, 10 years maturity, 0 coupon, or infinite bond, depends on the market, is 2%. Okay. The beta of a lending company is 1.3. So remember, the 2% are government bonds, are supposed to be zero risk. It's a strong hypothesis. The beta of a lending company has been calculated using data coming from the past month, very often 3 months. It is 1.3. And the expected return of the market, it means, in fact, the value, the return value, which has been, which is presented by the future markets on a 3 or 6 month horizon, is something like 5% a year. What kind of calculation could be made? Explain what are the strengths, weaknesses of these calculations and analysis. So this is somewhere behind. So the calculation is here on point 6. And in fact, what we're able to do here is to calculate using the Golden Shapiro, the capital asset pricing model, excuse me. We can calculate the cost of equity. So we find the classic formula first, okay, cost of equity. This is, okay, we found yesterday also in the Golden Shapiro formula, is equal to the risk-free rate, government bonds, 10 years, plus beta multiplied by the expected return of the market minus the risk-free rate. So we just have to make the calculations here. It's quite simple, right? We have 2% for risk-free rate, with a beta which is 1.3. We have 5% minus 2%, which means it is 2% multiplied by 1.3 multiplied by 3%, and this is equal to 2% plus 3.9%, and at the end we find 5.9%. So we have a cost of equity which is 5.9% with a risk-free rate which is 2%, which probably means also that the business premium or financial premium for these risks, which can be added to the risk-free rate to find the cost of equity, are very low. It means probably the liquidity level is quite important to the market as it is today, for example, in Western countries. And there is no volatility in the interest rate market, or nearly no or low volatility, something like 10% volatility calculated. And we have an excess of cash available compared to the situation you can anticipate with that kind of data. So this is a kind of calculation we can go through. This is what we can obtain, and this is also, we can say a few words on the hypothesis behind all the data you use. On the calculation and the results you find. This is just what I did a few seconds before with my analysis on the state of the bond market, liquidity level, volatility level, and so on. So this is for question number 6. We are still here, somewhere here. And I'll move back to slide number 6 now. And on slide number 6, you find again, another question, which is question number 7. And it is said here that the financial manager expects long-term dividend growth to reach 3% a year. Why not? When you have a look to the forecast, and I will do that for you next time. Generally, the financial managers, they don't expect long-term dividend growth. They are working on the earning per share and on the payout ratio. But it means at the end, when you work on a forecast of net earning per share, of course, after that, and if you make a decision or prepare a decision in terms of payout ratio, in fact, it's easy to have a short forecast of dividend growth. And here, when the calculation is made, financial manager believes that for the long term, the dividend growth will be something like 3% a year. He also expected, this is much easier for him to find something which is quite correct in terms of function comparable with what will happen. But the next dividend to be paid short-term horizon will be €7. Do you think these forecasts fit with the calculations? Explain and discuss. So you have some calculation, comparison, analysis, and comments to go through. Yeah, it's a bit more complex, not only the application of a formula. Okay, so this is what you find, which is somewhere on another slide here. So we have a good knowledge of some elements here. G, you don't have to calculate G. It's given, it is 3% a year. It means we don't have to go into a difficult regression calculation and measure after that the quality of the regression, with the variance, with the distance, and so on. Okay, I have just to integrate the 3% into the formula. Okay, what we also know is that the next dividend and the risk on the data is very limited because it nearly decided, or it is decided but not paid at the moment. But it's very short term anyway. It's a 7. And then you get the value of K, the value of the cost of equity, because the cost of equity, as you know, and you see that above, question 6, it was calculated using the capital asset pricing model. So we have a cost of equity, which is 5.9. This means that the potential price of share, proxy, let's say for a price of share, using these two models together is equal to 7, the dividend divided by 5.9%, which is the cost of equity calculated using the capital asset pricing model with quite a great number of hypotheses behind, minus 3%, which is supposed to be the long-term growth of the dividend, which is a consequence of the analysis of the future income statement, net earnings per share, and payout ratio. And at the end, you find this price, which is 241, or point, and if you prefer, 241 euros and 14 cents. So the question now is, we have different calculations here. And remember, if you go back to question 3, we have a market value of a share calculated, using the two data we know, the book value of a share and the market to book value ratio, which is 250. Okay. But of course, the market to book value ratio is also either coming from past history, like the data of a company, or it is coming from benchmarks, from comparables. So you take 3 firms which are supposed to be comparable, you take their price of share, you take their book value of a share, you calculate the result market to book value, perhaps you find 3 different results, that's generally the case, 2.4, 2.5, and 2.6. You make the average. Of course, you have a question, do we have to weight these multiples or not? Let's say it was decided not to weight them. So you have 2.4, 2.5, 2.6, you calculate the arithmetic average and you find the 2.5. Yeah. So you understand it's quite interesting. It gives you a proxy, but other methods with other hypotheses can give you other values. And this is what's happened here. Instead of 250, we find 241.14, which is not so bad, we just have 9 among 250 as a deviation from first one to the second one, which means it seems that there is some kind of coherence. I will not say it's identical, but it's very similar, using 2 different calculations, with the first one very simple, based on a simple model, and the second one based on the group of models, which are the capital asset pricing model and the Gordon Shapiro model. So if you come back to my question here, do you think that Forsker's field of calculation? The answer is yes. It's clearly yes. And you can validate all these calculations. That's what we do. So I wanted, before moving further, I wanted, to show you with this exercise, or to come back on a few points and to integrate them into valuation calculation. And we had first an analysis, and we come back on that, of a debt equity ratio, of the capacity of repayment, could have a calculation of a free cash flow, you know how to do that, and after that, measure the debt capacity of a company. And we identify where is the problem, and here the problem is not in the return analysis, it is in the financial structure. And generally, when it is a problem or difficulty in the financial structure, the only answer is to increase the level of total equity. That means to ask the shareholder to bring some more cash and to make an equity issue. You know, we did that in the preceding course. We know how to structure an equity issue for cash. Mm. So after that, we made the analysis of the total equity level. We know here the book value of a share, and we know that year after year, this company decided to keep in its balance sheet part of the net earnings, net income of the year, and to make distribution of dividend for the other part. And the result is that after several years, we have, 12,000 level, 12,000 euro level of total equity, but split, segmented into two categories: 5,000 euros of equity, which were brought perhaps year after year or in several steps, with several equity issues by the shareholders, and 5,000 euros retained earnings, which were accumulated in the decision process to allocate the net earning of the years. So we know immediately that as the equity level is valued in terms of book value per share, and that if there is an excess, means the difference of the price of an equity issue and the book value, this part, the difference, will be incorporated into the retained earnings. For example, if we make an equity issue with a price of a share of 150, 100 for each share will be allocated to the equity level and 50 to the retained earnings level. So now, when we understand that, it's easy to calculate the number of shares, and the number of shares is found when you compare the level of equity and the book value of one share. That's what we did here. After that, we try to use the market to book value ratio, market value of company, and we have some comments also on how we explain and how to explain the difference between the market and the book value of a company, which is clearly very close to what I said. If the market to book value ratio is 2.5, that means, of course, that the value of a share, market value is 250 compared to 100 for the book value. And the market value of a company is 250 multiplied by the number of shares which are available. Okay, this is what we have. How do we explain, in fact, the difference between the book value and the market value? It's just when you have a difference between the market value and book value, it's first because the firm has accumulated, positive results in the past. Okay, and this is incorporated at that level, and also because it's a growing firm, and the market value takes into account the discounted future cash flows. So you have a forecast, financial forecast, calculate the free cash flows, as we did yesterday with Sanofi case, and you calculate the net present value, discount all these free cash flows, and you calculate the net present value of all these three cash flows, and this is in fact the future cash flows value at the point in time at the moment of your analysis, and this is the main explanation of the difference. Okay. Very often, what do we do when we are not really able to make the calculations as we did with the table I showed you yesterday in Sanofi? We use comparables. If we find the 2, 3, 4 firms which are benchmark comparables very similar to that firm, and if we have knowledge of their market to book value ratio, or we have knowledge of their market value because they are listed and their book value because it's easy to find in their balance sheet, we can calculate a proxy of their market to book value ratio. In general, what we do is we take the market to book value ratio of the different comparables and we make an average with a question behind what kind of average, arithmetic average, or weighted average. Okay. So this is what, and we understand that this is a proxy anyway. This is a proxy. In question 4, we went back to how to finance an investment because perhaps strategic reason, because they want to keep also equity which is available, or we think that future projects could be financed mainly only by equity because they are, for example, in research and development. This is the case for pharmaceutical firms. Each time they have an investment project can be financed by debt or by leasing, they use that leasing because they want to keep their potential capacity to obtain new equity for shareholders to finance projects which cannot be financed by debt or by leasing contracts. Research, for example, investment in commercial teams, which is the second one. So here we add 4,000 euros of debt for that kind of reason. But the problem is that we don't have enough debt capacity. We have only 3,000 debt capacity, if you remember the result of the analysis, which means we need at least 1,000 euros equity issue before going further. With 1,000 euros, equity issue can obtain 1,000 euros more debts, straight debts. So the project, the investment project will be financed, but at the end, the problem you find is that, we will not have any more debt capacity. The ratio will be 100%, which means also if next time next time will be in a few months, we have a new project to finance, we will have difficulties to finance this project. It will be probably better, and this is one discussion, that kind of very simple case, if we decide to make an equity issue, to design an equity issue with a larger amount of cash, perhaps something about 3,000 or 4,000 euros instead of 1,000, to keep a potential debt, positive debt capacity. So this is point 4. Point 5, remember that? We decided to make, or they decided to make a new investment with finance by leasing, and seems that it was an investment eligible simply to a leasing contract, so for example, transportation material, and it is for 3,000 euros. It is a second investment there. And what we said is that leasing contracts are split into 2 categories, operational ones and financial ones, and only the financial one takes place in our analysis here. The other one are like classical cost incorporated into the income statement year after year, but financial ones are similar, very similar to debt contract, with a few differences, which are at least two options, one in the hands of the user, which is a call, and the other one, which is like an insurance contract in the hand of the lender. So, but you can have more, kind of more complexities in contracts, of course, but you have minimum two options. The equivalent debts, will be incorporated into the balance sheet right side with all the medium and long-term financial debts, and on the other side you will get an asset which is equal to the level of a debt at the beginning, at least. Okay. So consequences is to modify the size of the balance sheet, to modify also the percentage of the different parts of the balance sheets. You don't have any change, on the other hand, of the networking capital. Still the same level, at least at the beginning, and of course, year after year, the payments are made, the amount of debt is decreasing, and on the other side, the asset is depreciated in the accounting system at the same speed. That's what we do. You can note that even if there is no more debt capacity after financing the preceding investment, because we use only the 1,000 equity issue, we can perhaps make this investment using a leasing contract, just because the coupled leasing contract asset is less risky for the lender than a couple debt plus equity and asset. Just because the lender is still the owner of the asset and can bring back in his courtyard the asset as long as the rents are not paid, if the user doesn't follow the repayment schedule which is incorporated into the contract. So you increase the debt capacity because you reduce the risk using this method, and in fact, you bring an insurance policy inside the contract, a hedging policy, for prefer these words. This is very, very clear. And that is what we do in many financial design, policy design. For example, I don't know what it is in Vietnam, but when you buy a flat here in Europe or in the States, you can increase the amount of debt which is accepted by the banks if there is an insurance contract on the debt. So there's several ways to obtain an insurance contract, either from the bank itself, from an insurance company, for other legal guarantees. Point 6, it's more calculation. Yeah, we have a risk-free rate, a beta. We have an expected return of the market, and first question is, what can we do about what kind of calculation we do? So, as you know very well now, the classical formulas and valuation techniques. So what you can do to apply the capital asset pricing model, and with the capital asset pricing model, you can obtain the last data, which is not calculated yet, which is the cost of equity. So this is what you do. You apply the classical formula, and you made the calculation, and you get the value, the proxy again of a cost of equity using the capital asset pricing model. But you know that we have different hypotheses behind, but the quality of the data is not as good as you expect. You know that you use past data for the beta, you use future data for the expected return of the market, and you use a kind of spot data for the risk-free rate, government 10-year maturity, and sometimes zero coupon, sometimes it is infinite, which is not exactly the same, even if the difference is not very high. Question 7. The financial manager, now he's there and he asks you what could be the value of share and the value of the company, and he wants to understand if the result of this calculation will fit with the calculation you did using the simple model. Okay, so it's now an application of the Gordon-Shapiro model. And we know in the Gordon-Shapiro model that we need at least 3 data to calculate the last one. What we are expecting, the last one, is here the price of a share. And if you remember the calculation, yeah, it is here. We know here the expected return of the market, which is the future contracts on large indexes, 5.9. Which is 5%. We know the risk-free rate, which is 2%, beta, which has been calculated, which is 1.3, and we can apply in a very classical way the formula. And we get at the end 5.9% for the capital asset pricing model for the cost of equity. When we move to the Gordon-Shapiro model, that's what I was explaining. You get the value of K you just calculated, 5.9. You got the value of G here, which is supposed to be 3%. And the last dividend, which is 7, which means you get 7 divided by 5.9 minus 3%, which is 7 divided by 2.9, equal to 241.14. And you compare the 241.14 to the 250. And you understand, of course, that again, in the Gordon-Shapiro model, we have several hypotheses which are quite strong. The G value here is also a proxy. D0 is more for confidence, it's a very short-term element, and generally the decision is made in advance, even if the dividend is not made. Okay, and K is under the hypothesis of the capital asset pricing model. Okay, so we have also a proxy, and the comparison between the 241 and 250 shows that it's quite coherent. It's not exactly the same, it's not identical, but it's very similar. That means also that very often, when we have good knowledge of the models, very good, we take into account the hypotheses below each data calculation. At the end, we obtain something, some results, some values which are not so different. Okay? But of course, the determination of price using different values quite easy, I would say. So this is what I wanted to show you today in terms of application of what we have done before on these models. This is clearly a part of what I want to do with you, and you are supposed to know very well right now. I'm here with slide number 9 and slide number 10, you know. Slide number, excuse me, I've lost my slide. Yes, yeah. 11, yeah, it's 9 and 10, correct. And 9 and 10, we are back on the biotechnology case, but you know very well this case. You find here in 9 and 10, this is what I said yesterday, you find some more elements to improve or facilitate your calculations, analysis, and comments, you know, and of course your presentation will take place, as we know, in the middle of November. Okay, so you have time to prepare the exam given by my colleague, Professor Pramwan, and then to prepare your presentation. So let's have a look to these two slides in order we will clear what is to be done. All of you get a copy, you know, of biotechnology. We start from the basic case you already studied, used and studied in the financial analysis course, and also in the diagnosis and financial policy course. And I add progressively some more elements, information, data, and so on. Let's read the content here. The P ratio is supposed also to increase from 1.6. 1.6 is what you find in that case, exhibit 1, to 1.8, and later to 1.9. This is the consensus of the financial analysts. That means generally, you know, you have several financial analysts which are following the company, and they publish forecasts, recommendations for investors also. And of course, you find websites where you calculate and they present the different expectation of the PEs and some other data to the potential investors and potential investors, and they aggregate. They find a kind of recommendation using generally the average of these different expectations. And this is what you have here. This is the average expectation of the financial analysts for the years to come for the P ratio. Well, that means you are back in something which is similar to the Sanofi case. You have to make some kind of sensitivity analysis for the different, including the different scenarios. If you are willing to, you can also extend these scenarios, taking in 1.6, 1.8, 1.9. The differences are not so important, but add another year and perhaps move to 2.2 and to 1.4, and you will understand what will be the consequences of these evolutions, and what should be the resilience of a company to survive or to finance correctly these situations. Point 2, Mr. Vincent, you remember Mr. Vincent is the main guy there, and the CFO, Mr. Barnet, are planning to distribute 25 million euros of dividend during the 5 years of the plan. This is what is said, and you have already integrated this data into your calculation from 2000 to 2005. If the equity stay at the same level. however, don't agree on the payout ratio level. And this is new information. Mr. Vincent thinks it should be constant. It means, what does it mean? It means you distribute the 25 million regularly. Each year it will be 5. And which doesn't mean the payout ratio is constant. The dividend is constant, not the payout ratio. It's what Mr. Vincent thinks. He thinks, we have to give a clear message to the financial market and to shareholders, and that the fact that to have a recurrent dividend is much more important than to have a recurrent payout ratio. Mr. Bonnet thinks that after an initial dividend the first year, because if you remember what you did last time, we are planning here very quickly an equity issue and perhaps 2 equity issues, making a large amount of cash. So Mr. Bonnet thinks that after an initial dividend the first year, before an equity issue, a dividend should be 0 the second year, and later increase regularly with a constant growth rate. That's what he thinks. Constant growth rate during the last 3 years of the plan and after. So an equity issue should be, packaged, prepared. A dividend, is a kind of signal given to the shareholders, positive signal. So an initial dividend here should be planned, perhaps with an increase compared to the preceding dividends, preceding years. But after that, the situation of the company will not be so good, even we take into account the equity issue during a few years. And for 1 or 2 years, probably the market and the shareholders don't expect any dividend. But after 1 or 2 years, the policy of dividend distribution has to start again and to grow regularly in terms of growth rate, but with an increase in terms of amount. So you have here 2 different potential policy. Another one could be added, and which is really quite usual, is to say, okay, let's come back to the position of Mr. Vincent. The dividend has not to be constant, but payout ratio constant. It's a better idea because at the same time, there's some written earnings available and calculated on a regular basis for the company, for the total equity. And it is something we can explain also to the shareholder. But anyway, escape to any kind of opportunistic and difficult to explain dividend policy. Third, the interest rate on the long-term bonds is more volatile since the beginning of the year 1999. What will be the consequences of a change in the government bond interests? If you have a look to the table exhibit 2, you find 5% for the 10 years during the last period of time, which is analyzed. And what happens if the interest rate on these bonds will go up from 5 to 6.5%? What you can do, if you like, is to extend this analysis. What is the sensitivity to the interest rate of the different variable you study and different equilibriums and data you obtain? That means also if the increase is not from 5 to 6.5, but to 6 or to 7 or even to 7.5, what will happen? Point 4, the operating income before depreciation to sales ratio, depreciation to sales ratio is 5%. No? Lower than the average ratio in the industry. The average market value to book value in the industry is 5.8. So what do you think about that? And what can you do when you expect if we can be back in the average market situation of the market? What are the consequences of the restructuration of the operations in order to find at least the average data found into the analysis of the industry? Point 5, an investment in Germany will improve the EBITDA to sales ratio by 10% in the first year. If you had a look, remember, you read again the case, there is an investment in Germany, which is just mentioned. A proposal of merger without dilution of wealth and control, increasing the size of biotech by 30%. Total level of sales, 30% of the total level of sales. The first year, which is 2001, is under negotiation. What are the consequences on your financial policy and on the value, of course? Point 6, the expected return, which is the data you find in the capital asset pricing model, is expected to increase by 10% in 2000 and 5% the 4 following years. What are the consequences? And of course, I encourage you to integrate at the same time in this question 6, the consequences of your calculation and perhaps other hypothesis you made in question 3 on the interest rate. I can run a small scenario, small scenarios there, make a simulation and try to explain what is very sensitive and important. Point 7, what could be the expected value of a company and the price of a share if an IPO is scheduled for 2000 and a second one for 2004? Before you should deal with question 4, 5, and 6, page 6 of the case. So if you go back to the case, you find a few questions. My recommendation here is read carefully and deal with question 4, 5, 6, and then integrate these two ideas. What are the consequences of on the expected value or future value of a company and the price of a share, of course, but it's not difficult to find the price of a share when you know the expected value. If an IPO, first IPO is scheduled in 2000 and the second one 4 years later. So this is a very interesting question. So this is what I wanted to say on this slide number 9. Let's move now to slide number 10. And slide number 10 is different. It's still on biotechnology and the work you have to go through. But anyway, it's more how to do it, but what are the points you have to think about and to find answers to. first spend time reading the case again. Probably it was a few weeks ago and you've completely forgot, but probably after one or two new approach of a case, you will remember clearly and be ready to deal with a different question. Read again the financial analysis and financial policy paper you wrote. They have been done. Okay, so you should use them. Point 3 here, a few points to remember before moving to the last 3 questions are in point 4. Remember what are the main characteristics of this firm before going further. High investment rates, very high investment rate when you have a look to the data. And since that they are very successful in the choice of their investment, but anyway, these investments have to be financed. They create more fixed costs also, even if they bring higher growth rate measured by different tools. Second, we have a low debt capacity here, but perhaps you can use, other financial resources. They didn't use any kind of leasing contract up to now. They have also very high return for shareholder, and this is an increasing return year after year. And there's a margin probably in the structure of total equity. They didn't use any kind of preferred share. That means that if you want to keep control, majority, you can define it as you want. It will give you a definition. Perhaps the fact that they can issue preferred shares will allow them to finance the growth, but also to solve the problem of control. They have an unstable dividend policy, which will make it difficult to use result from models integrating the dividend, like the Gordon Shapiro model, at least if they are based on the past. But if you design first, your dividend policy as it is recommended in the beginning slide, you will have some kind of relatively stable and explainable dividend policy, which will be much easier to incorporate into the models, and particularly into the Gordon Shapiro model. It seems at the moment they have a stable shareholder group. Is it a strength, or is it a weakness, or is it both? Just because you have a group to control a majority, but also perhaps they don't have enough financial resources to bring the necessary equity to the company. So how to solve this problem? These are the main points. So remember that I don't want 50 pages this time. I want a short paper, something like I would say 4 pages plus 2 pages of exhibit. The kind of professional paper you can pass to your colleagues in a bank or in the company. Not the kind of student paper as you were accustomed to write at the time you were student in a bachelor program. So this is what I wanted to say on that. You will receive another email I wrote. It will be sent by Miss Thuy Lin very soon. It was done this morning. And if you think that data are lacking, you can make your own hypothesis, but explain your own hypothesis. Or you can raise me questions, send me emails, and I will add some more data in order, perhaps it facilitates or it makes your analysis more detailed, more accurate. So this is what I wanted to show you here on the biotechnology case and your future presentation. But you have time to do it. We are only today still in October, on the 20th, and your presentation will take place on November 17, 18. It means you get about 4 weeks to do that, even if you have more over courses and in a few days, one of the perhaps important exam. Financial structure is a very important course. You will have time to go from through this preparation. So don't hesitate to send me an email if it is necessary, but perhaps wait the message sent through Mrs. Thuy Lin probably tomorrow. It has been written today, but the message has to be repackaged before being sent to each of you. So what I did up to now today, was really two things. I wanted to come back to the beginning. I just wanted to present you the structure of today's presentation, summarize the main parts of the yesterday presentation. Then we moved immediately to this exercise of small case called a link company, which is summarizing and integrating together many parts we had the opportunity to study before, either in the first session of this course or in preceding courses. And we had made parts which are just calculations and applications of models and capital asset pricing model and potential capital. But also we had discussion on financial structure. We have also discussion on how to use, leasing contracts and why to use leasing contracts and how to take them into account, in the design of the financial policies. We raise also questions for very common, if we take into account, if you analyze the hypothesis behind each of the data and each of the methods, each of the models. And our conclusion was, if we do that properly and the data are collected in the right way, the differences in value should not be very, very high. It means, of course, we have a range of values, but the extreme paths will not be so far one from the other, which will facilitate at the end the movement, decision to make to choose a price among the large number of points available in the range, and that's really hope to also to escape to his stupid way to make arithmetic average of values to find the price. Okay. And on another element was, of course, on biotechnology. We slide number 9 and 10. I added some more elements here. I tried to identify a few ways to develop simulation and scenarios, and to give you a few advice and how to make at least your written presentation at the moment. Remember that you will write a paper, and you will at the same time make an oral presentation here, as you will do also on the signal case. This is what I wanted to say on these elements I went through. Now, second part of the session, we're at slide number 11, and we still have in front of us, a certain number of slides. Okay. Up to slide number 22, it is the case itself, which will be presented with some calculations. And starting from 23, 24, it is another presentation. It is the presentation of elements you will have to take into account in your preparation and presentations, written and oral. It's just what I presented you a few minutes ago on biotechnology, and you will find more elements also in the message, which will be sent by Mrs. Twilin. Next, it is the end here. Next is 25 and 26, last two slides here. Again, we will have availability of a few questions raised in past exams on the points we have we identified and we discussed today in the Allen company and the signal case. So this is our goal right now. So let's go back to slide 11. I think it is 11, yeah. And slide 11, you find the beginning of this case, which is the electrical signal company. Very often I call it signal, it's more simple, or ES, and you find here on the first line, the equity of electrical signal company ES, electrical signal. Okay, so you will understand anyway when there is the word signal, it means that it is this company. Okay, so we will go through the different steps of the case with the calculation, and I try to introduce a few more elements and problems. What about the use, for example, of market value and market value and bond value? What to do for the debt level? Do we have to use market value of debt and bond market value of debt, or bond value of debt, or the historical value of debt? What are the differences? What about leverage here? And what's happened if you move from book value data to market value data? Does it change the value, the leverage level? Does it change also the risk of a company? Does it mean that the risk level is dependent on the evolution of the interest rates of the market? Which are very basic questions in finance. You will find an application also of the different models we have met, on the calculation of the cost and returns and the long-term growth of dividends of preferred shares. We will be able also to calculate, the costs of the equity level, with equity level with the aggregation of the ordinary shares and the preferred shares. We will calculate also the market value over different dates, whatever they are, and taking into account this information, we'll have the possibility to make a calculation of the weighted average cost of capital, with these new hypotheses, and to understand if one is, excuse me, a function of this complex financial structure, including leasing, including preferred shares and convertible bonds, and also of the market values and interest rate modifications. So, of course, these have consequences on the value of a firm, which is the last question we will meet here before moving further on this case next time, and moving today, if we have more time, on the last slides I identified with you a few minutes ago. So we are there, beginning of slide 11, and I'll go into this case right now. But now, it's something, it's nearly 10. For me, it's nearly 10 to 4. For you, it's really 10 to 9, so let's have a break right now, and we come back in a few minutes, and start with this second case of the day, after the Aline case and after the data I brought to you on the biotechnology case. Thank you. Have a coffee or dinner, I don't know. Have a coffee. And back in 10 minutes. Okay. So I think it's time now to start again for the second part of this session number 3. And we will deal, as I said before break, that I will go through with you this case, starting slide 11, which is the electrical signal company, yes. So let's go into the case and try to find the analysis of interest and try to answer to the questions which are raised by that case. The equity of electrical signal company here is made as 675,000 ordinary, what we call also standard shares, with a book value of 100 euros and a certain number, 225,000 preferred shares. It's about 1 to 3. Book value also 100 euros. The market value of the ordinary shares is 550 euros and 400 euros for the preferred shares. So you understand that there is a difference in the market value. The market value to book value of shares is not the same for both categories of shares. And the dividend paid for the first one is 12 euros and 18 euros for the second one. And there is a tax impact also because of the fiscal system which is behind. So you understand that they are not, valued the same way, by the stock market. And this is very often the case. It depends also, of course, all the element characteristics of shares, because the difference in the return, dividend, explain partly this element, and also the fact preferred shares get a right to vote or not, or the same right to vote than the ordinary shares. So here you are in a case where there is no right to vote for preferred shares. They have, as you will see later, you will see here a higher dividend. But for the market, it seems that the higher dividend doesn't compensate, in fact, the lack of the right to vote. Okay. So, of course, in that case, it doesn't compensate, and if the market is well is efficient, the arbitrage between the two categories of shares is correct. You get a price for the ordinary shares, which is higher than the price of the preferred shares. And this is what you find here in the first paragraph. Second element, the structure of the balance sheet is the following. Net fixed assets 450, operating working capital 330, okay. Cash for 20, and the total of the left side of the balance sheet is 800 million euros. Okay. Total equity 490. You had 3 zeros, of course, at the same time, for each of the numbers. Retail earnings for 260. Long and medium financial debts, including bonds, for 100. Long-term loans for 120. And leasing for 60, short-term financial debt for 117. The total of the right side of the balance sheet is 800. So, of course, you find the same total, 800 both sides. Okay. You find here a presentation of the balance sheet, which is more an economic presentation than a classical accounting presentation. For example, the operating working capital is presented, in the left side, completely calculated. It means it is the inventory plus the receivables minus all the total of your operational debt. Okay. And on the right side, what is interesting, of course, if you have a total equity with a distinction, as we mentioned earlier in the lean exercise, with equity for 90 and retained earning for 260. So we can calculate the total of the total equity level, which is equal to 260 plus 90. And after that, you have different categories of financial debts, long, medium financial debts, including bonds, long-term loans, leasing, which has been incorporated here, and short-term financial debt. So, of course, we have to take into account the different characteristics of these different elements, both sides, on the asset side and on the liability and equity side. A few more elements on the bonds. The bonds included, point 3 here, slide 12. In the balance sheet are in fine bonds. Hopefully their calculation will be more simple than for equal repayment. And also the cost and returns will be comparable because the structure is identical. And the average maturity is 8 years. They show a fixed interest rate of 12.5%. The same kind of bond issued today by the same company with same risk level will receive an 8.5% interest. So they were issued years ago. 8-year maturity. We are a few years after. They were issued at a 12.5 fixed interest rate. And today on the market, for the same kind of issuer, same risk, the interest rate will be 8.5. It means the valuation of the risk is not the same today as it was a few years ago. For the long-term debt, the repayment schedule is the following one. Well, at your T plus 1, 16, T plus 2, 20, T plus 3, 24, T plus 4, 13, T plus 5, 30 also. We have a calculation of a weighted average interest rate cost, if you prefer, of these loans, as we did in the past exercise, it's 11%. And the new issue today, and with same structure, same maturity, some average maturity, would be made at a 9.5% interest. The net present value 5 of leasing amounts, interest included, which was 60 million euros, is now 67.2 million. The after-tax costs discounted at the present time of the leasing contracts is 7.5%. So we have leasing contracts, they are financial lease, they are included in the presentation of a balance sheet. We know the original value, we know the value right now. It's quite understandable, it's time because we had an increase, well, charge, which is a decrease in the interest rate, and that's an impact on the market value also of leasing contract. We know also what is the After tax costs discounted at the present time, take into account the elements which are fixed in the contract, and take into account all these elements to conclude that the after-tax cost of the leasing contract is 7.5%. We have short-term debt, and the interest here is relatively stable, and is 11%. And short-term debt, have been issued a few months ago. Generally, it means if you are not in a period of crisis, but of constant increase or decrease, slow increase or slow decrease, it is clear that a few months after, we can assume that the interest rate has not been modified by the market evolution. The best, it is assumed here some either element or hypothesis, the best presentation of the balance sheet or the financial structure takes into account the share values and the financial debt values at the market price and not at the book value. So you can consider here both presentations and analyze the differences and the consequences of these differences. We know, point two, that book values don't take into account the present, today, market conditions and only bring the past value situation. Three, the book value of total equity is not a good proxy of potential growth of a firm. The book value doesn't integrate, that's what we have said several times with our words. It doesn't take into account the discounted future cash flows to the present time. Point four, the book value of debts do not include the interest rates increase or decrease. Point five, in order to find the best proxy of a WACC used to finance a new investment project, it is recommended to use market values of equity and financial debts. So this is discussion here on principle, on rules. And we understand that the rules which are applied in the accounting system doesn't fit with the goals we are following in the kind of process we go through, which is an analysis of the financial structure, of the cost of the financial resources, of the debt capacity, of the leverage effect, and of the value. 14. Let's start with a few calculations right now. What is the equity value for the ordinary or standard shares? Here we know that we have 675,000 shares, and the market value is 580, and you find the result here, 391,500,000 euros. Same calculation for the preferred share. Equity value of the preferred shares. 400 each, 225,000 shares. And again, these 90 million euros, find on the line number 4. That means that the total equity value here is equal to total of these two numbers, 391,500 plus some of the 30 missing here, plus 90,000, which is equal to 481 0.5. And of course, 0.4 of this data, which is a market value of equity, should be compared to the 350 registered in the balance sheet. The market value is higher than the book value, and the market to book value ratio here is 481.5 divided by 350, which is 1.37. It means a positive net present value of future flows, future expected flows, discounted to the present time. So expectations are quite positive for this firm. Let's have a look to the debt side now. The structure of the bonds. The hypothesis used in the below calculation is that the bonds are infinite bonds with an 8-year average maturity. It is clear that with a longer or shorter maturity, or with a structure which could be different, zero coupon, equal annual payment, equal annual repayment, the calculated will be different. So in that case, it is easy because during the years before the last one, the firm pay only, the company pay only the interest. The interests are fixed interests, and because the basic value, book value, and the interest rates are fixed for the 8-year period. So from t equal 1 to t equal 8, the interest to be paid are equal to 0.12 multiplied by 100, which is 12 million euros. And on year t equal 8, the loan itself is paid back. It's paid back for an amount of 100. So that means that the total here to be paid would be slightly different. But the net present value of the bonds calculated as the financial market rate interest now is what? We have an 8.5 interest rate on the market for that kind of bonds right now, which means if you want to make the calculation, you have to take into account from your 1 to 8, 1 to 8. We have to take into account the interest, 12, for each year, divided for each year by 1.085 t, moving from 1 to 8. So we have 8 different calculations here, and we calculate the total sum S of these different calculations, plus for the last year, 100 divided by 1.085. We have taken into account the fact it is at year 8. Make the calculation, and we find 119.74 million euros. So it means the net present value of these bonds has increased because the interest rate decreased. And we have to take into account in the calculation a 9.5% interest and not a 12% interest. You can read the last sentence here of the slide. The net present value of the bonds, market value, is higher than the book value found in the balance sheet. And this is explained, as we know, by the decrease in the interest rate level. If we had, on the contrary, an increase in this interest rate level, we have the final result moving the other way around. It means it will be under 100. So if, of course, we had another example with a 6% interest and not an 8.5, the value found here will be something probably like 130, perhaps 135, much higher. So that means, for example, when you buy bonds, you put bonds in your portfolio, what you are expecting, of course, if you are fixed interest bonds, is in a decrease in interest. You mean you get each month in cash, an interest which is higher than what you can get on the market now for the same maturity, same risk, and same structure. But also, if you have a look to the total value of the bond, including the interest and the final repayment, you will have an improvement. And this is what you are looking for when you invest in bond, of course. Loans now. For the loans, we have also a change, we are moving down in terms of interest rate level. And now we have a 9.5 interest rate, which is a decrease compared to the initial interest rate. And we will make the same kind of calculation, taking into account, the table of the outflows, interest included. And of course, when we have built this table, designed this table, we discount these flows at the rates of the interest rate of the market for that kind of debt at the moment of the analysis. So the value of the long term, the ALT here, is equal to S. S with is total, sigma, in fact, with T, the number of years moving from 1 to 5, and of the yearly payment, and all these should be divided by 1.095, and we will obtain 124.82. If the initial interest rate would have been kept during the period of time, 5 years, and it was 11%, we will have, of course, found 120. So that means the evolution from 11% to 9% has brought an increase in terms of market value. Market value is not anymore equal to book value, but market value has increased because the interest rate has decreased from 11 to 9.5. We can check all that more precisely with the design of a table, and you have got here a table in front of you, which starts with the year, debt amount at the beginning of the year, the payback each year, the interest also paid, the yearly payment. You understand that we start with 120 level of debt, and as the payback first year is 16, we get 104, the interest rate will be 13.20, which is 11% of 120. It means what is paid at year one is equal to the payback repayment 16 plus 13.20 of interest, which is equal to 29.20. Now, if from 104 you eliminate now another repayment for the year after. If you do that for the year after, you will get 104 minus 20, which makes 84, and you calculate at 11.5, 11%, the interests, which are 11.44 to be paid on the basis of 104, which means in period 2, the cash paid is equal to the repayment of the year 20 plus the interest 11.44, which is equal to 31.44. Year 3, and this is in the contract, of course, the repayment is 24, which means if the debt is 84 at the beginning of the year, the debt amount will be at the end only 60. And the interest rate of 11% applied to 84 gives you 9.24, and the total paid at period 3 will be 24 plus 9.24, which is equal to 33.24. Okay, and for period 4, you start from 60 as a basis of calculation, which is debt amount at the beginning of the period. We pay back 30. It means at the end of the period 4, or beginning of the time, we have only a debt amount of 30. The interests, which are 11% of 60, is equal to 6.60. The total paid is 30 plus 6.60 equal to 36.60. At last, we have on year 5, beginning of year 5, a debt amount which is 30. We pay back 30, but we have to pay 11% interest on this basis, which is 3.30. And the total paid cash outflow is 33.30. So this is the structure you will obtain, here. And this gives you, when we make the calculation, we discount all these elements, all these payments, which is the right column. When you do that, and you discount this at the market interest at the time of the analysis, which is 9.5 and not 11, you find out 24.82. So you have, in fact, translated all these numbers in value, which are market value. We have made several calculations now on slide number 17, and we're able, in terms of market value, to calculate, the total value of the debts. We make the calculation for the bonds. It is 119.74. A calculation for the long-term debts, 124.82. It has been done and given in presentation of a case for the leasing contract, 67.2. And we get short-term financial debts, which are still the same. We have decided there is no charge, taking into account a very short period of time, which is included here. It's 170. So you make this calculation 119.74, 124.82, 67.2, 170. You have included all the kind of financial debts, not only the classical straight debt, long-term, medium-term, issued to the market obtained from the banks, but also the leasing contracts or the equivalent debt to the leasing contracts for the leasing contract, and the short-term financial debts issued obtained from the banks. And you get the number, which is for 81.76. So you have another view of the financial structure of a company. I've got another view, and you can compare, the financial structure, which is here, for the equity, for financial debt, in terms of book value and market value. What we know, of course, we knew at the beginning the book values. For total equity, it is 350. For financial debt, it is 450. The total is 800. Okay. What we have calculated, it is on the right side. We obtained 481.5 for the total equity level and 481.7 for the financial debts, which is nearly equal. Total of the balance sheet here is 963.2. If you don't include the operational debt, which has been included into the left side through the calculation of the operating working capital. Okay. So when you consider the balance sheet, you understand that balance sheet size has increased. We don't have the same balance sheet. We had a total of 800, we have a total of 963, which is, let's say, 160 higher. And 160 is about 20%. So to take the market values, increase the size of the balance sheet by 20%. That's what we found here. Now, if we calculate a proxy of financial leverage, which is also here, relation between the financial debts, including leasing and including the short-term financial debt, compared to the total equity, before making the calculation and taking only the book values, we found 1.29. And now, with our new calculation, we have 1. So this market value of financial leverage, which is 1, has to be compared to the book value financial leverage, which is equal to 1.29. So the question is really what to do. What is the best hypothesis in the next calculations? And you understand that in many reports and even textbooks, we use only book value, which is a mistake. And in the following calculation we go through in the next slides, we will make the hypothesis of a financial leverage equal to 1. And this, of course, has an impact on the WACC calculation. If it has an impact on the WACC calculation, okay, whatever are the values, the cash flows, the portfolio of investment, left side of the balance sheet, it is clear that it will modify the return of this portfolio and the WACC. So the WACC is a function of the leverage calculation, and moving from book value to market value will modify the WACC. it can increase, it can decrease. It depends on what's happened, to the interest rates. What's happened also to the market value of shares compared to their book value, and quite in good sequence are the elements, the comparable elements of financial leverage. So let's move now to the next slide. The next slide is here. And we have made an analysis of the financial structure. We have reincorporated the market values, decided to take them into account in the next calculation and approaches. But now we are interested by the costs of different financial resources, and particularly, of course, by the weighted average cost of capital. That's what we spend time on in the next minutes. What about the standard shares costs? We use, of course, the capital asset pricing model again. So we explain here on that slide what is R0. It is the cost of a standard ordinary shares, standard ordinary shares. It is not the cost of equity as a whole. Okay, the expected return of the market is the expected return of a diversified market portfolio, 12%. The RF is still equal to the risk-free interest rate, 8%, beta, volatility, systematic risk, what you prefer, is equal to 1.4, as we know, and the RO, which is this cost of equity for the standard shares, is equal to what? Is equal to the risk-free rate, 8, plus the expected return of the market, 12 minus 8, multiplied by the beta, which gives us 13.6. So we have calculated here the cost of equity for the ordinary shares, and it is 13.6, but it doesn't mean, that it is the cost of equity for all the parts of the equity. So we have to go further right now and to move to the other kind of share we have here, which are preferred shares, and try to understand what's happened for the preferred shares. And we will see again that we will use two different models before trying to find a kind of average, weighted average cost of the equity. As I would say, equity as a whole, integrating the ordinary shares and the preferred shares. So now we will use the Gordon-Shapiro model to calculate the long-term growth rate of dividends. Okay, so how can we do that? Okay, we get these 13.6, which is the costs of equity of the ordinary shares. We know the next dividend, which is 12 for the ordinary shares, and we know the price, which is 580. It means we can use the Gordon-Shapiro model. And this is what we do here on the last line of this slide. And you find the value of G, which is equal to the cost of equity minus the next dividend to be paid divided by the price. 13.6 minus 12 divided by 580, which is equal to 11.5. That means that in a long run, G, which is, as you know, the long-term growth rate of dividend is equal to 11.5%. We also know that preferred shares, they get, the same dividend plus an interest, some fixed element, which means that in fact the total paid each year to preferred shareholders, if it is on a graph, it's a parallel line to the line of the ordinary shareholder, with a difference which is equal to this interest rate. That means the slope of the line is the same. And if the slope of the line is the same, that means the long-term growth rate of the dividend plus the interest paid to the preferred shareholder is the same as the slope of the line, which is a representation, a good representation of the situation of the shareholders of the ordinary shares. So 11.5 value G here can be used for the ordinary shares owners and also for the preferred shares owners. And this is how it works. This is the connection between both calculations. So at that level, we are able to make a calculation, of the preferred shares costs. We're able to do that. It means, again here, we can use one of our models. And it is also, again, the Gordon-Shapiro model. So that means we have used first the capital asset pricing model. This is what we did. Then we have used the Gordon-Shapiro model. We have explained what's happened, why the value of G is common to the two group of shareholders. And we can apply again the Gordon-Shapiro model to the situation of the preferred shares owners. Okay. And here, what do we do? If we want to calculate, the something which is comparable to what we have done for the ordinary shares, for the preferred shares, it means if you want to calculate the costs of these preferred shares, cost of equity of preferred shares, equity, we need to use again the same model, and we get a dividend, which is 18 and not 12 right now, divided by what? By the price then of the market, which is 400, and not 580 anymore, plus G. But G, as we try to explain, is the same for both dividends, for those payments to the ordinary shareholders and to the preferred shareholders, 11.5. Make the calculation, and you get 16%. This is what we have. This calculation is valid if we make the assumption that the growth rate of dividend for standard and preferred shares is equal in the long run, but this can be assumed easily. The only case it can be assumed so simply, it is if the surplus of payment to the preferred shareholders will not be stable over time. It means if the two straight lines representing the dividends in the long run will not be parallel straight lines. And this will be a much more difficult case to integrate into the models. So now, what do we have right now? If we try to summarize the elements for equity, we get costs for the standard shares, which is 13.6. For the preferred shares, it is 16%. The amounts are 391.5 and 90, taking into account the data we know out of first calculations. So this is each time coming from a calculation we have done first, value of the ordinary shares, value of the preferred shares. Total equity is equal to 481.5. Okay. So if you calculate the weight in terms of market value of both resources, integrated and taken into account, added into the total equity, we have 81.3 for the standard shares and 18.7 for the preferred shares. That means the total is equal to 100%. And what you can do if you want to make a calculation is now to calculate the cost of total equity with the standard shares cost 13.6, with the preferred shares cost 16%, okay? And you take a 13.6 multiplied by 0.8813 and 16% multiplied by 0.187, and you find 14%. So total equity cost here is a weighted average cost. And each time we have complex equity structure, you have to calculate, a weighted average cost of total equity as you calculated, for example, in preceding cases or examples, the average cost of debt. This is exactly the same technique. It is a kind of general approach of the cost calculation of both different categories of resources. The only main difference here is the discussion on book value and market value. And of course, we understand, but probably, it's not very certain, we make, in general, a mistake taking into account book values in the calculation. We know we need to make calculation using market values, and this will modify the leverage we have to take into account after that in the analysis. So at that stage, we are ready to apply the same approach to the debt side. We are ready to do that. Okay, we are here now inside the 21, okay? 21, 22 is here, 21 is here, right? And we start with the cost of bonds and financial debts. Bonds cost is 8.5% for an amount of 119.74. This is what we have calculated. And total, which is 481.76. And we understand that the weight here is 24.9. Long-term loans, the cost is 9.5, market value of interest. The amount calculated in the preceding slide is 124.82. The weight is 25.9. Leasing, we already knew that the cost was 7.5. The amount is 67.2. It's nearly included into the data brought into the case, and the weight 67.2 divided by 481.76 is 13.9. Short-term debts 11%, no charge. Amounts 170, no charge, and 170 compared to 481.76 is 35.9. Okay, so we know exactly what are the amounts, what are the costs, and what are the weights. Now, this is what we needed. Okay, now we are able to make a global calculation of the cost of weighted average cost of capital, and we are also able before to make a weighted average cost of debt. We have two steps here, 1 and 2 of this slide, and this was the goal we wanted to reach in this second step of a case. Okay, so let's have a look first to the weighted average cost of debt. We have, and this is in the case itself, 34% tax rate, which is very high. And what's to averages now? The averages in the OECD country is about 24-25%. In some countries like Ireland, for example, which is in the European Union, we have 12.5%. But in some of the countries like France, it's still about 30%. So we have to take into account this tax rate into the calculation. So it is, as we did before, 1 minus 0.34, 0.34 multiplied by all the other elements. You get 8.5 first, 8.5 for the bonds, multiplied by 24.9% plus 9.5% for the loans, with 25.9% weight, plus 11% multiplied by 0.353 for by 3, which is the short-term loans, plus, and it is not in the bracket because leasing contract 13.9% to 6.63. So we got the 6.63 after tax costs of debt, weighted average cost of debt, integrating tax effect, integrating also the market values, and in situation the firm is profitable. These are the hypotheses behind. Now, if you say it's not profitable, we have something different. If you decide that the tax rate will be 20% and at 44%, you have something different again. So you can make scenarios, you can make a sensitivity analysis of the value obtained here, RD, taking into account, all these variables with parameters. With this value, anyway, in that situation, we can calculate the weighted average cost of capital after tax, including short-term financial loans, including leasing contracts with market values in a profitable environment. Okay. We have, of course, here a ratio which is equal to 1. And the WACC is very easy to calculate because we just have two numbers. We have the weighted average costs for total equity, which is calculated in the preceding slide, 14%. And we have on the other side the costs, just calculated for the debts, including short-term, including leasing, and here we have 6.63%, which means 0.5 multiplied by 14% plus 6.63% is equal to 10.32% after taxes. This is our calculation, and this is what you should use in most of the calculation you will go into finance. If, of course, the environment is a profitable environment, it will be different if there is no tax effect. And this will move also depending on the interest rate, depending on the market value of shares and the state of the market. Is it bullish or is it bearish? Profitable, the environment is profitable or not. So the WACC is a kind of relative data. It's not a kind of absolute data. We work, as you know, as it was said by Olivier Cousin before, to work and try to minimize this data. And to minimize this data, we have to manage many different elements, parameters, and variables. So this is what I wanted to show you on that case at the moment, at least. Remember what I did? I said, in any case, I need a weighted average cost of capital. But the problem is much more difficult than it is said. First, we have to take care of the values of the total equity. And here we have preferred shares. So we need to calculate the cost of equity of the standard ordinary shares and the cost of equity for the preferred shares. We have two different calculations. We have two different market price of the share. We have two different returns, because we know that preferred shares have a better dividend plus interest than the dividend of the ordinary shares. This was done first. Second, we came back on all the debts included, or CASI debts included into the balance sheet. It means bonds, it means loans, classical long-dated loans. It means also leasing contracts and last short-term financial loans. And we went through a calculation of their market value, taking into account the evolution of the interest rate, taking into account also the maturity and the structure of these bonds and loans, and integrating here also the leasing contracts. So we were able, to redefine the structure of debts included into the balance sheet, with weights based on their market value and costs integrating the interest rates of the market. It means the changes in the interest rate structure for that category, for that class of risk of a firm. With these elements, we were able to find the table, including for total equity and total debts, the values in the two different measures. We know book value and market value, and we're able to calculate also the leverage effect in both circumstances. And the change in the leverage effect, when we move from the book value to market value analysis in a world with decreasing interest rates, and a very positive situation for the firm with future flows discounted at the present time being positive. And we see that the leverage and the risk is decreasing. Lower interest rates, market value much higher than book value for shares means lower debt equity ratio, means lower leverage, lower risk for the firm, and generally better returns at the same time. Then second part here, we went through the calculation of the cost. And the interest here is to calculate first the cost of equity ordinary shares, then the cost of equity preferred shares, and using, successively capital set pricing models and twice the golden Shapiro model, ensuring that the way to move from the ordinary shares to the preferred shares is the hypothesis we have on the long-term growth rate of the dividends and payments here. The two straight lines are parallel. So G, the slope of the lines is the same. So G is the same also in both models. So then we were able, to calculate the weighted average cost of the total equity. And we were also able, using the same intellectual approach and practical calculations for debts. When we have done this, we have a total cost of an average cost, total average cost for total equity, and we have an average cost also for total debt. And we take, of course, 0.5 as a weight, which is a market weight, a new leverage data, and we calculate WACC, taking into account the hypothesis, a level of tax rate, 34% here, the fact that the firm is supposed to be profitable also, and we have work which is more feasible with this calculation than with the traditional calculations. That's what we have done today. So I really did what I wanted to do, to make a summary of past session 2, make a presentation of session 3. We went through the lean first case. We dealt with biotechnology. Okay, that was very clear, I think. And then we moved into all the calculation, hypothesis, and analysis of the two first steps of this case signal. After that, when I'm there, we have a few elements here on the company valuation case you can integrate. It is just the same as I did, for the biotechnology case. It means in slide 23 and slide 24, I give you some elements, more elements of calculation, and I ask you, starting from what I presented today, to make calculation, sensitivity analysis, design scenarios with tax rates which are different, and you see on that slide here, 23, 15%, 25%, interest rate which are 6% instead of 9.5%, presenting a sensitivity analysis which is 0.2, and then here also I introduced different scenarios on the capital asset pricing model calculation, and later on the right, with a beta moving from 1.4 to 1.2 and 1.7, a risk rate which will decrease, an expected return of the market which will increase, and I say 0.4, but you should calculate the value of the company using different methods, finding a range before choosing a final value for a potential merger and also for an IPO. The average EBITDA on sales of comparables is 30%, which is quite important here to make a larger analysis. At the last sales level of the electrical signals company is 1,500 euros. The market value to EBITDA ratio is 3 in average in the economic sector. And last, the PE of a company can be calculated and compared to the average in the semi-economic sector, which is 21. So we get more data, and of course I'm interested in the value or values and price for an IPO of this company. I will deal with the question next time, and anyway I can come back also to have time to read what I did today. Before I will come back on the 23 and 24 slides before moving to the question 25, 26, and to other topics in session 4. But you have a few days to do that, because the session will be only on next Wednesday. I should have correct, next Wednesday, and before you have your exam with Praman and time to read again what I did today and my new information, data, and question for your presentation of the 2 cases, biotechnology and signal. So it's really time to have a rest right now for you. It's late. I wish you a good night. Invest in a Praman course first before moving to mine, and I will see you anyway for session 4 in a few days, and we'll give again some more elements or advice or data. And if you think that something is missing or have another question, don't hesitate to send me an email on these points. So it was a pleasure. Good night and see you soon, and work hard and take care to you and to your family anyway. Bye.
Goodbye, Professor.
Goodbye to all of you.